tenths of percent to a percent at this point in time. But let's get talking about earnings season in everything to do with the budget. We've forgotten that there's an earnings season which is upon us as well. CRISIL expects a mild recovery in the first quarter of FY15 according to their latest report. Prasad Koparkar, the Senior Director of CRISIL Research, now joins in to talk about that. Hi Mr. Koparkar, thank you very much for taking the time out. I'll first start with IT in specific. Considering that emphasis is on Friday, what do you expect in terms of the IT space and earnings from that stable this quarter?
Right. Yeah, I think IT will continue to do fairly well. We expect dollar revenue growth of about anywhere in the range of 12 to 14%. And given that rupee on a year-on-year basis is still about 6-7% weaker despite recent appreciation, rupee revenue growth on a YOY basis will be close to about 18 to 20%. And in terms of margins, we believe that there will be margin expansion somewhere in the range of about 150 basis points or so on a YOY basis. This is partly driven by better growth and reduction in bench. So both these things will provide some support to margins as well.
Okay. Good afternoon, Mr. Koparkar, and thanks so much for joining in. You expect revenue growth to bounce back in this quarter to 9 to 11%, but can the revenue growth as well as the profit performance be sufficient to drive earnings upgrades overall in Q1?
Right. I think this quarter, as you will see, that revenue growth had actually rebounded in the last 2-3 quarters. I mean, if I look at a year back, first quarter of last year, revenue growth was just about 4.5-5%. From there, we have already come a long way. Even in the last 2 quarters, we have seen revenue growth touching close to about double digit. We think that trend is likely to continue. Yes, I think there are some imponderables in terms of what happens to monsoon, what happens to budget, but overall revenue growth should be improving going forward. Whether that helps in terms of overall earning upgrade, I think it is going to take some time. Earning upgrades we don't see in a big hurry for the current financial year, but I think overall sentiment and the numbers for the next financial year will definitely look much better.
Okay. What is your expectation from the banking space? Do you think that PSU banks will maintain asset quality because of selling loans to asset reconstruction companies? So maybe optically the gross NPAs and net NPAs will look better, but then we have to assess what the absolute figures of the slippages and restructured would be, and that might still be disconcerting according to you?
Right. No, right. I mean, asset quality has been a big issue for public sector banks especially. While we don't see things improving dramatically, what we have seen so far, even in our portfolio of rated credits, is that the pace of downgrades has significantly gone down. And our discussion even with bankers suggests that the slippages have come down, so we don't expect numbers to worsen, but very unlikely that NPA numbers will look better. And as you are aware, from last quarter we have seen some sale of assets to ARCs by some of the larger public sector banks. And you're right, in one way it only optically improves the numbers, because the performance in terms of the actual recovery, it still desires a lot to be expected. So we don't expect overall gross NPA numbers to improve. I think they will remain at somewhere in the range of 4 to 4.5%. But the slippage rate is declining, and that is, I think, clearly a positive sign.
Okay. Mr. Koparkar, we saw pretty strong June auto sales numbers. There was a marked improvement that we saw. Will it translate into better numbers for all these auto companies on a quarterly basis?
Yeah, I think if you're right. I mean, June numbers were definitely good. In fact, some of the companies beat the general expectation. Our sense is that two-wheeler and passenger car clearly will show a robust growth on a YOY basis. Even margin improvement will be there, because actually some of the raw material prices have also come off. Commercial vehicles still, I think, is facing challenges. On a YOY basis there will be still a decline, but things will look better, I think, from second quarter onwards. One, because of the continuing benefit of the excise duty which is there for the passenger vehicles, as well as the big base effect. I mean, if you look at commercial vehicle in the last 2 years, I think we have lost almost 50% of the volume. Last 2 years we had seen 25% plus YOY decline. So base effect will come back, and with overall economy improving as we generally expect, I think from next quarter even CVs will start looking little better.
What is your expectation from the metal space? Because if I recollect correctly, Hindalco actually reported a good set of numbers last quarter on account of, the highest ever aluminum sales that they did. Do you expect that trend to continue maybe for the metal space and maybe some amount of outperformance from the likes of Hindalco?
Yeah, you're right. I mean, I think on the metal side we have seen last year was one of the worst. I think first time we saw a negative aluminum demand growth in the domestic market after many years. So with demand recovering, I think things will start looking better. Even in steel space, for example, we expect companies like Tata Steel to start doing little better. Their overseas operations are also likely to do little better. The prices on a YY basis, especially in some of the segments, given there is still some benefit of rupee depreciation, are going to look better. But I think the big issue for metal space, whether non-ferrous or steel companies, is when the volume will pick up. The volume growth is still very subdued, just 2 to 3%. Unless that improves, I think sustainable improvement in metal space is unlikely.
Okay, and one last question. Last quarter, for the last many quarters, investment as well as capital expenditure linked sectors like capital goods as well as construction have seen seen considerable weakness. So for instance, revenue in the capital goods sector last time declined by close to about 19%. What's the expectation for this quarter?
No, this quarter also I think, while the overall sentiment has improved, our discussion with companies suggests that, the actual implementation benefit is going to take some time. So these companies, as you are aware, were impacted, one, because of the entire slowdown in the actual implementation, as well as issues they have been facing on the, the liquidity as well as the capital structure. I think both these issues are going to take some time, and we don't see things improving in this quarter or maybe even next quarter.
Okay. Mr. Koparkar, quickly before we let you go, just a quick one-word answer or two-word answer in terms of the sector that you expect an outperformance in earnings from and maybe an underperformance.
Right. No, I think in terms of outperformance, I mean, I won't again talk about sectors like, the all-known pharma, IT type. I think clearly we expect some part of auto, two-wheelers and passenger vehicle to do a little better. I think telecom is one space where we are seeing significant improvement in the operating metrics. The customer acquisition costs are coming down. The overall metrics is looking better. So I think we expect again a margin improvement there.
Okay, Mr. Koparkar, we'll leave it at that. Thanks so much for joining in and giving us your expectations for the coming quarter. Time now to shift focus. Naveen Mathur of Angel Broking now joins in on the show. Good afternoon, Naveen. Thanks so much for joining in. Crude prices have been fairly subdued.